An upward sloping trend line indicates a bullish trend, suggesting that buyers are in control and prices are likely to continue rising. A downward sloping trend line signifies a bearish trend, indicating that sellers are dominant and prices may keep falling. By identifying these trends, traders can align their strategies with the prevailing market direction, increasing the likelihood of successful trades. One of the key benefits of trend lines is their role in identifying potential support and resistance levels. In an uptrend, the trend line acts as a support level, where prices are likely to bounce back up after touching the line. This provides traders with potential entry points for long positions. In a downtrend, the trend line serves as a resistance level, where prices may face selling pressure and decline after approaching the line, offering potential entry points for short positions. Trend lines can also signal potential trend reversals. When the price breaks through a well-established trend line, it often indicates a shift in market sentiment. For example, a break below an upward sloping trend line may signal the end of an uptrend and the beginning of a downtrend. Traders use this information to exit existing positions or initiate new trades in the direction of the emerging trend. Confirming the breakout with additional technical indicators, such as volume or momentum oscillators, helps reduce the risk of false signals. In addition to their simplicity and visual clarity, trend lines are versatile and can be applied across various timeframes, from short-term intraday charts to long-term monthly charts. This flexibility allows traders to use trend lines in conjunction with other technical analysis tools to enhance their trading strategies. For instance, combining trend lines with moving averages, Fibonacci retracement levels, or candlestick patterns can provide a more comprehensive view of the market and improve decision-making. In summary, trend lines are a crucial element of technical analysis, offering valuable insights into market direction, support and resistance levels, and potential trend reversals. By drawing trend lines on price charts and using them in conjunction with other analytical tools, traders can make more informed trading decisions, align with prevailing trends, and identify optimal entry and exit points. The simplicity, versatility, and effectiveness of trend lines make them an indispensable tool for traders of all experience levels. You cannot take home some money daily without a favorable risk-reward ratio. Trading trend reversals involves identifying and capitalizing on points where a market trend changes direction. This strategy requires a blend of technical analysis, patience, and discipline to accurately spot these critical junctures. Here's a detailed guide on how to effectively trade trend reversals. Firstly, identifying potential trend reversals begins with recognizing the current trend. Traders use trend lines, moving averages, and other indicators to determine if the market is in an uptrend, downtrend, or sideways movement. An uptrend is characterized by higher highs and higher lows, while a downtrend shows lower highs and lower lows. A trend reversal occurs when these patterns are disrupted, signaling a change in market sentiment. One of the most reliable tools for spotting trend reversals is the use of technical indicators and chart patterns. Indicators like the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Bollinger Bands can provide clues about overbought or oversold conditions, which often precede reversals. For example, if the RSI indicates an overbought condition in an uptrend, it could suggest an impending downward reversal. Similarly, chart patterns such as head and shoulders, double tops, and double bottoms are classic signals of potential reversals. A head and shoulders pattern, for instance, typically marks the end of an uptrend and the beginning of a downtrend. Candlestick patterns also play a crucial role in identifying reversals. Patterns such as the hammer, inverted hammer, engulfing patterns, and doji are often seen at the end of a trend and indicate a potential reversal. For example, a hammer candle at the bottom of a downtrend suggests that buyers are stepping in, potentially reversing the trend. Confirmation of these patterns is critical, which usually involves subsequent price action validating the reversal signal. Once a potential reversal is identified, confirmation is necessary before entering a trade. Confirmation can come in the form of a significant price movement in the opposite direction of the current trend, often accompanied by increased trading volume. For example, after identifying a head and shoulders pattern, a trader might wait for the price to break below the neckline with high volume before considering it a confirmed reversal. Risk management is paramount when trading trend reversals due to their inherently risky nature. Traders should always set stop-loss orders to limit potential losses. These stops are typically placed above resistance levels in a downtrend or below support levels in an uptrend. Additionally, position sizing should be carefully considered to ensure that any single trade does not excessively impact the overall trading portfolio. Lastly, patience and discipline are essential in trend reversal trading. It's important to wait for clear signals and confirmation before acting. Prematurely entering a trade can lead to false signals and losses. Traders should also remain flexible and ready to adjust their strategies as new market information becomes available. In summary, trading trend reversals involves recognizing current trends, using technical indicators and patterns to identify potential reversals, confirming these signals, and implementing strict risk management practices. By following these steps with patience and discipline, traders can effectively capitalize on trend reversals and enhance their trading performance. The market is in work. China's relationship with gold is multifaceted and strategically significant, reflecting its economic aspirations and historical affinity for the precious metal. As one of the world's largest producers, consumers, and holders of gold, China plays a pivotal role in the global gold market. China is the largest producer of gold globally, with extensive mining operations spread across the country. The Chinese government has encouraged domestic gold production to reduce reliance on foreign sources and to support the local economy. The development of the gold mining industry is part of China's broader strategy to strengthen its position in the global commodities market. This robust production capacity ensures that China has a steady supply of gold, bolstering its reserves and contributing to its economic stability. On the consumption side, China is also the largest consumer of gold, driven by both cultural and economic factors. Gold holds a significant place in Chinese culture, symbolizing wealth, prosperity, and good fortune. This cultural affinity is evident in the high demand for gold jewelry, particularly during festivals and weddings. Additionally, Chinese investors view gold as a safe haven asset, especially in times of economic uncertainty or when there are concerns about the stability of the financial system. This dual demand from both the retail and investment sectors underscores the importance of gold in the Chinese economy. The People's Bank of China, PBOC, China's central bank, plays a crucial role in managing the country's gold reserves. Over the past decade, the PBOC has significantly increased its gold holdings as part of a strategy to diversify its foreign exchange reserves and reduce reliance on the US dollar. By holding substantial gold reserves, the PBOC aims to enhance China's financial security and stability. These reserves act as a buffer against economic volatility and potential currency devaluation. The PBOC's consistent accumulation of gold has also been interpreted as a move to bolster the yuan's credibility and facilitate its acceptance as a global reserve currency. In addition to managing reserves, China has developed a sophisticated gold trading infrastructure. The Shanghai Gold Exchange, SGE, is one of the largest gold exchanges in the world, providing a transparent and regulated marketplace for gold trading. The SGE has introduced several initiatives to internationalize gold trading, including the establishment of the Shanghai Free Trade Zone, which allows foreign investors to trade gold on the exchange. These efforts are part of China's broader strategy to exert greater influence over the global gold market and to promote the yuan in international transactions. China's Belt and Road Initiative, BRI, also has implications for the gold market. As part of this extensive infrastructure and economic development project, China is investing in numerous countries that are significant gold producers. These investments often include the development of mining projects, which can increase China's influence over global gold supplies and enhance its strategic interests. Moreover, China's approach to gold reflects its long-term economic strategies. By accumulating gold, promoting its domestic market, and enhancing its trading infrastructure, China aims to safeguard its economic reserve management, and trading infrastructure. The country's strategic approach to gold underscores its importance in China's economic policy and its efforts to enhance financial stability and global influence. This multifaceted engagement makes China a key player in the global gold market, with significant implications for global economic dynamics. The three principles of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these principles, you are on right track. A double top pattern is a bearish reversal pattern that typically signals the end of an uptrend and the potential beginning of a downtrend. This technical analysis pattern is characterized by two distinct peaks at approximately the same price level, separated by a moderate trough in between. It resembles the letter M and indicates that the asset's price has encountered a resistance level twice, suggesting a shift in market sentiment from bullish to bearish. The formation of a double top pattern usually occurs over an extended period, ranging from several weeks to several months. The first peak forms as the price rises and hits a resistance level, where selling pressure begins to outweigh buying interest, causing a temporary price decline. This decline leads to the formation of the trough, or support level, as the price encounters buying pressure once again. The second peak forms when the price rises back to the resistance level, finding sellers once more. The key aspect of this pattern is that the second peak should be at a similar price level as the first, confirming the resistance. For traders and analysts, the double top pattern is significant because it suggests a shift in market dynamics. The completion of the pattern is confirmed when the price breaks below the support level formed by the trough between the two peaks. This breakdown is typically accompanied by increased trading volume, reinforcing the bearish signal. Once the breakdown occurs, traders often anticipate a continued downward movement, with the price potentially reaching the level equivalent to the height of the pattern projected from the breakdown point. However, it's important to note that the double top pattern is not infallible and can sometimes lead to false signals. Traders should use it in conjunction with other technical indicators and analysis to confirm the validity of the pattern. Additionally, monitoring trading volume during the formation and breakdown can provide further insights into the strength of the reversal. Low volume during the breakdown, for instance, may indicate a lack of conviction among traders and the potential for the pattern to fail. In summary, the double top pattern is a reliable indicator of a potential trend reversal from bullish to bearish. Its formation involves two similar price peaks separated by a trough, with confirmation coming from a breakdown below the trough support level. While it offers valuable insights, it should be used alongside other analysis tools to ensure accurate trading decisions. First plan your trades, and then trade according to your plan. No need to rush. MetaTrader 4, MT4, and MetaTrader 5, MT5, are two of the most popular trading platforms developed by MetaQuote software, catering to Forex, commodities, and other financial markets. While both platforms offer robust tools for trading and analysis, they have distinct differences that may influence a trader's choice based on their specific needs and trading strategies. MetaTrader 4 is renowned for its user-friendly interface and reliability, making it the go-to platform for many Forex traders. Launched in 2005, MT4 has become a staple in the trading community due to its simplicity, extensive charting tools, and a vast library of custom indicators and automated trading systems known as expert advisors, EAs. Its ease of use makes it particularly appealing to beginners, while its depth of features satisfies the needs of experienced traders. MT4 supports multiple order types, advanced charting capabilities, and a wide range of analytical tools, making it a versatile choice for technical analysis and strategy development. MetaTrader 5, introduced in 2010, is the more advanced successor to MT4, offering several enhancements and additional features. MT5 is designed to provide a broader range of asset classes, including stocks, futures, and options, making it suitable for multi-asset trading. One of the significant improvements in MT5 is the inclusion of an integrated economic calendar and advanced order types, such as fill or kill, FOK, and immediate or cancel, IOC, which provide greater flexibility in order execution. MT5 also boasts a more powerful backtesting environment for automated trading strategies, allowing for multi-threaded and multi-currency testing, which can lead to more efficient and accurate optimization of EAs. Despite the advancements in MT5, many traders continue to prefer MT4 due to its established presence and the vast ecosystem of third-party tools and customizations developed over the years. The MQL4 programming language used in MT4 is different from the MQL5 language in MT5, meaning that EAs and indicators are not directly transferable between the two platforms. This has led to a slower adoption rate of MT5 among traders who have invested heavily in MT4's ecosystem. Additionally, some brokers offer only MT4 due to its widespread popularity, further reinforcing its dominant position. However, MT5 is increasingly being recognized for its superior performance and expanded capabilities. It supports more timeframes and built-in technical indicators compared to MT4, providing traders with more granular analysis options. The platform's enhanced market depth feature offers a more detailed view of market liquidity, which can be crucial for traders employing advanced strategies. MT5's improved interface and additional functionalities are designed to cater to the evolving needs of modern traders who require access to a diverse range of markets and sophisticated trading tools. In summary, the choice between MetaTrader 4 and MetaTrader 5 depends largely on a trader's specific requirements and trading style. MT4 remains a favorite for Forex traders due to its simplicity, reliability, and extensive support from the trading community. In contrast, MT5 appeals to traders seeking a more advanced platform with greater multi-asset capabilities and enhanced analytical tools. Both platforms have their strengths, and traders should evaluate their individual needs, including the types of instruments they trade and their reliance on custom tools, to determine which platform best suits their trading strategy. The gold market is in shift. Lot size is a fundamental concept in Forex and gold trading, significantly impacting a trader's risk management, potential profitability, and overall trading strategy. In Forex trading, a lot refers to the standardized quantity of a currency pair being traded, while in gold trading, it typically denotes the amount of gold, measured in ounces, being bought or sold. Understanding and selecting the appropriate lot size is crucial for effective trading. In Forex trading, lot sizes come in three main types: standard lots, 100,000 units of the base currency, mini lots, 10,000 units, and micro lots, 1,000 units. The chosen lot size determines the value of each pip movement in a trade. For example, in a standard lot, each pip is worth $10, in a mini lot, $1, and in a micro lot, 10 cents. Consequently, larger lot sizes can lead to higher profits from small price movements, but they also increase the potential for significant losses. Traders must therefore align their lot size with their risk tolerance and account balance to avoid overexposure. In gold trading, lot sizes are typically measured in ounces. For instance, one standard lot in gold trading often equals 100 ounces of gold. The value of each price movement, or tick, in gold can vary depending on the market and the broker, but it generally follows a similar principle to Forex trading. Larger lot sizes mean greater potential profits or losses. Given the volatility of gold prices, choosing an appropriate lot size is essential to manage risk effectively. Effective risk management in both Forex and gold trading is closely tied to the selection of lot sizes. Traders use lot sizes to control their exposure to the market. A larger lot size increases the leverage effect, which can amplify gains but also magnify losses. Therefore, prudent traders calculate their lot size based on their total capital, ensuring that no single trade can deplete a significant portion of their account. A common risk management rule is to risk only a small percentage, such as 1 to 2% of the trading account on any given trade, adjusting the lot size accordingly. Another important consideration is margin requirements, which are directly influenced by lot size. Larger lot sizes require more margin, or collateral, to open and maintain positions. This means that traders with smaller accounts need to be particularly cautious about over-leveraging, as this can quickly lead to margin calls or forced liquidation of positions. By selecting an appropriate lot size, traders can ensure they have sufficient margin to sustain their positions through market fluctuations. Lastly, the choice of lot size affects the psychological aspect of trading. Trading large lot sizes can induce stress and lead to emotional decision-making, especially for inexperienced traders. By starting with smaller lot sizes, traders can build confidence and experience without taking on excessive risk. Over time, as they develop a more robust trading strategy and a better understanding of market dynamics, they can gradually increase their lot sizes in a controlled manner. In summary, lot size is a critical factor in Forex and gold trading that affects risk management, profitability, margin requirements, and trader psychology. Selecting the appropriate lot size helps traders manage their exposure to market volatility, protect their capital, and maintain a disciplined approach to trading. Whether trading currencies or gold, understanding and carefully choosing lot sizes is essential for long-term trading success. Gold is moving. Choosing between manual and automated Forex trading depends on various factors, including your trading style, experience level, and personal preferences. Here's a detailed comparison to help you understand the differences and make an informed decision. Manual Forex trading. Manual trading offers significant control and flexibility. Traders have full control over each trade, allowing for adjustments based on real-time market conditions. This flexibility enables traders to incorporate new information and adapt to changing market scenarios swiftly. Moreover, manual trading enhances your trading skills and understanding of the market through direct experience, providing the opportunity to develop and refine your strategies and techniques. However, manual trading is time-consuming, requiring constant monitoring of the markets, which can be very demanding, especially during high volatility periods. Emotional influences are a major drawback, as traders can fall victim to biases like fear, greed, or overconfidence, negatively impacting trading decisions. Maintaining consistent execution can also be challenging, particularly when dealing with multiple trades or complex strategies. Automated Forex trading. Automated trading, on the other hand, offers efficiency and speed. Automated systems execute trades at lightning speed, capitalizing on even the smallest market movements and handling multiple trades simultaneously without human error. This method eliminates emotional influences, ensuring consistency and discipline by adhering strictly to predefined strategies and rules. Additionally, automated trading saves time, requiring less active monitoring and allowing traders to focus on strategy development and other activities. It also enables backtesting and optimization of strategies on historical data, helping evaluate performance and fine-tune parameters. Despite these advantages, automated trading lacks flexibility, as it cannot adapt to unexpected market conditions or news events not accounted for in the algorithm. The rigid adherence to predefined rules may result in missed opportunities or increased losses. Technical issues, such as software bugs, connectivity problems, or server outages, pose another risk, requiring regular maintenance and updates to ensure optimal performance. There's also the risk of over-optimizing the trading strategy to past data, which may not perform well in live markets, known as curve fitting. Lastly, setting up a reliable automated system demands a significant initial investment in terms of time and money, along with ongoing costs for software updates, data feeds, and possibly VPS hosting. Choosing the right approach. Consider manual trading if you prefer having full control over your trades, enjoy analyzing market data and making discretionary decisions, are willing to invest the time required to monitor and manage trades actively, and value the learning experience and skill development from direct market interaction. Opt for automated trading if you have a well-defined, tested trading strategy that can be coded into an algorithm, want to eliminate emotional biases and maintain consistent execution, have limited time to spend on active trading but still want to participate in the market, and are comfortable with the technical aspects of setting up and maintaining automated systems. Ultimately, some traders use a combination of both methods, leveraging the strengths of each to optimize their trading performance. For instance, they might use automated systems for certain strategies or market conditions while manually trading others. The expert advisor is working. The history of Middle East crises and their impact on gold prices is a testament to the geopolitical sensitivity of this precious metal. The Middle East has long been a region of strategic importance and geopolitical tension, with numerous conflicts and crises influencing global economic stability and, consequently, the price of gold. One of the earliest significant impacts of a Middle East crisis on gold prices was the Arab-Israeli War in 1973, also known as the Yom Kippur War. Following the outbreak of the war, the Organization of Arab Petroleum Exporting Countries, OAPEC, declared an oil embargo against countries supporting Israel, leading to the 1973 oil crisis. The ensuing economic instability and inflationary pressures drove investors towards gold as a safe haven, causing gold prices to surge. From 1972 to 1974, gold prices nearly quadrupled, reflecting the heightened demand for security in times of geopolitical turmoil. Another critical period was the Iranian Revolution in 1979, which led to significant political upheaval and economic uncertainty. The fall of the Shah and the establishment of the Islamic Republic disrupted global oil supplies, contributing to a second oil crisis. The ensuing economic instability and fears of broader conflict in the region once again pushed investors towards gold. Gold prices soared, reaching then record highs of over $800 per ounce by January 1980. The Gulf War in 1990–1991 also had a notable impact on gold prices. When Iraq invaded Kuwait in August 1990, it prompted fears of a prolonged conflict in the oil-rich region. The uncertainty and potential disruption to global oil supplies led to a spike in gold prices as investors sought a safe haven. Although the actual conflict was relatively short, the build-up and immediate aftermath saw gold prices fluctuate significantly, peaking at around $400 per ounce in late 1990. More recently, the Arab Spring uprisings in 2010–2011, which led to widespread protests and regime changes across the Middle East and North Africa, also affected gold prices. The instability and uncertainty caused by these uprisings, particularly in Egypt, Libya, and Syria, prompted a rush to safe haven assets. Gold prices saw substantial increases, reaching all-time highs of over $1,900 per ounce in September 2011. The ongoing conflict in Syria and the rise of the Islamic State, ISIS, in the mid-2010s added another layer of uncertainty to the region. As the conflict intensified and fears of broader regional instability grew, gold prices experienced periods of significant volatility. Similarly, the recent geopolitical tensions, including the U.S. assassination of Iranian General Qasem Soleimani in January 2020, briefly spiked gold prices due to fears of a wider conflict between the U.S. and Iran. In summary, the history of Middle East crises demonstrates a clear pattern. Geopolitical tensions and conflicts in this region often lead to economic uncertainty and instability, driving investors towards gold as a safe haven. These crises have repeatedly caused significant spikes in gold prices, underscoring gold's role as a refuge in times of geopolitical and economic turbulence. Always take calculated risk. News trading is a strategy employed by traders to capitalize on market volatility triggered by economic reports, geopolitical events, and other significant news releases. This approach leverages the swift and often substantial price movements that follow major news events, aiming to profit from the market's reaction to newly available information. News trading can be applied across various markets, including Forex, stocks, and commodities, but it requires a solid understanding of the news events that drive market behavior and the ability to act quickly. Economic indicators such as employment reports, inflation data, central bank announcements, and GDP figures are among the most influential news events in financial markets. These reports provide insights into the health of an economy and can lead to rapid price adjustments as traders and investors digest the new data. For instance, a stronger than expected jobs report might lead to an appreciation of a country's currency as it signals economic strength, while a disappointing report might cause a sell-off. Traders who can accurately predict or swiftly react to these outcomes can exploit the resultant price movements. Geopolitical events, including elections, policy changes, and international conflicts, also play a crucial role in news trading. Such events can create significant uncertainty and market turbulence. For example, unexpected election results or sudden geopolitical tensions can lead to sharp market movements as investors reassess risks and adjust their portfolios. News traders must stay informed about global events and be prepared to act on news that could impact the markets. The key to successful news trading lies in preparation and speed. Traders typically use an economic calendar to track upcoming news events and set up alerts to stay informed. Advanced trading platforms offer features like one-click trading and high-speed order execution, which are essential for capturing opportunities in the fast-moving markets following a news release. Additionally, traders often use technical analysis to identify key support and resistance levels, helping them to set entry and exit points ahead of the news. However, news trading also involves significant risks. Market reactions to news can be unpredictable and volatile, leading to potential slippage and unexpected losses. The initial market reaction may be followed by rapid reversals, making it challenging to secure profits. To mitigate these risks, traders use risk management tools such as stop-loss orders and position sizing to protect against adverse price movements. Moreover, understanding market sentiment and the context of the news is crucial. The same piece of news can have different impacts depending on the broader economic environment and market expectations. For example, a central bank rate hike might be bullish for a currency in a strong economic context but could be seen as a negative move if the economy is perceived to be weakening. In summary, news trading is a dynamic and potentially profitable strategy that exploits market volatility induced by significant news events. It requires thorough preparation, quick decision-making, and effective risk management. Traders who master the art of interpreting news and its impact on markets can capitalize on the rapid price movements that follow major announcements, turning timely information into trading opportunities. The market is active. Gold has played a pivotal role in the global economy for centuries, functioning as a universal standard of value, of exchange, and a store of wealth. Historically, gold's intrinsic qualities, durability, malleability, and scarcity have made it an ideal substance for minting coins and backing paper currencies. During the era of the gold standard, many countries pegged their currencies to a specific amount of gold, ensuring that the value of money was directly linked to gold reserves. This system provided a stable monetary environment, facilitating international trade and investment by reducing exchange rate risk and inflation. Even after the gold standard was abandoned in the 20th century, gold has continued to hold significant economic importance. Central banks around the world maintain gold reserves as a critical part of their financial strategy. These reserves serve as a safeguard against economic instability and currency devaluation, providing a reliable asset that retains value over time. In times of economic uncertainty or geopolitical tension, gold often experiences a surge in demand as investors seek a safe haven from volatile markets. This is due to gold's reputation for preserving wealth and its inverse relationship with major currencies, particularly the US dollar. In addition to its monetary and investment roles, gold also has substantial industrial and commercial applications. It is extensively used in electronics due to its excellent conductive properties and resistance to corrosion. Furthermore, gold's aesthetic appeal ensures its continued popularity in jewelry and decorative arts. The demand from these sectors supports the mining industry, contributing to economic growth in gold-producing countries. Overall, gold's enduring value is underscored by its multifaceted role in the economy. Its function as a financial hedge, a standard of monetary stability, and an industrial commodity ensures that gold remains an indispensable asset in the global economic landscape. The continuous evolution of financial systems and technologies may change the ways in which gold is utilized, but its fundamental economic significance is likely to endure. The candles are forming. Between gold and the prices of other precious metals such as silver and platinum. This correlation exists primarily with similar economic and market factors, such as changes in the global economy, currency fluctuations, and investor sentiment towards safe haven assets. Gold and silver, in particular, exhibit a strong correlation due to markets and their shared historical status. Both metals are seen as hedges against inflation and currency devaluation. When economic